Hello, my friends. This is Hilary, your mortgage coach. Thank you for joining me. Today, I am going to talk about home equity line of credit, HELOC. A few of my friends have asked me to address this topic, and so today I am going to address it for you. So, what is home equity line of credit, or HELOC in short? HELOC is a revolving line of credit secured by your home, and it is mostly at a lower interest rate than the traditional line of credit. So there are two types of home equity line of credit. So you could have a HELOC that is combined with your mortgage, or you can have a standalone HELOC. For home equity line of credit that is combined with a mortgage, this is normally available from the major financial institutions such as Royal Bank, TD, Scotiabank, BMO. Most of the financial institutions have the readvanceable mortgage, whereby as you pay off your mortgage, the HELOC component increases. HELOC can be paid off anytime. Typically, one pays interest only on the amount that they have borrowed. It is a very convenient way of purchasing properties if you have a significant amount of HELOC in your property. The home equity line of credit combined with the fixed mortgage can't exceed 65% of the property purchase price. If you have a significant amount of down payment when purchasing a home, you can structure your mortgage so that part of the equity becomes accessible to you through HELOC, and the other amount can be set up as a mortgage. You can decide this with your lender on how these two portions will be set, especially if you are working with me. I have used this method to create a significant amount of HELOC. Come see me so that we can set up your mortgage and your HELOC at the same time. It is easier to set up a HELOC when you are setting up a mortgage as opposed to later on when you need to use the line of credit. The portion of your home that you can finance with your HELOC can't be greater than 65% of the purchase price or the market value. You can refinance your home up to 80% of its purchase price or market value, but the remaining amount above 65% must be on a fixed term mortgage. The rules have now changed because of the current credit issues. The government is trying to reduce the amount of HELOC that people can access on their property. Their aim is to eventually only allow people to access 65% of their equity in total. So, for example, if you have a house that is worth $400,000 and you have a down payment of 20%, which is $80,000, the remaining amount would be $320,000. So, the maximum HELOC that you would be allowed on this property would be $260,000, which is 65% of $400,000, and the remaining 60% would need to be in a fixed term mortgage if you are to access the equity. If you set up your HELOC properly, when you are starting off, your mortgage will be high and your equity will be small. As you pay down your mortgage, you will have the line of credit available to you in full. And when you have it in full, it is easier for you to use the money for investments or other ways that you need to. For a standalone HELOC, this is just a product that is guaranteed by your home. It may not even be with the same lender. For this, it can go up to 65% of your home's purchase price or the market value, and it won't increase as you pay down the mortgage principal because this is a standalone HELOC. It is not related to the original mortgage. I normally advise my clients to go with a financial institution that has the readvanceable mortgage. So what's the difference between the HELOC, second mortgage, and home equity loans? So for a second mortgage, basically it is just identical to the normal mortgage, except that it has a higher interest. Second mortgages have a fixed interest rate and are a one-time loan that must be repaid within a certain time frame that you agree with your lender. Now for HELOC, on the other hand, it is just a revolving line of credit with variable interest rates that you may utilize at any moment. Because the interest rates change so much over time, the amount you owe on your HELOC payments each month may fluctuate significantly. And this has been evident over the last few months, because beginning of last year, the interest rate was quite low, less than 3%, and currently it is on the high 7s. So if you have a HELOC, the interest rate at the moment would be around 7.7 or 7.5. You've got to bear that in mind when you are getting a HELOC. Now, for a standalone home equity loan, it resembles just a credit card. A home equity loan is more like an original home mortgage. You borrow a specific amount and then you make regular payments during the fixed repayment period. For a standalone HELOC, you are not required to pay off the principal and interest on a fixed payment schedule. There is a higher minimum down payment. You would need at least 35% of the purchase price or the market value. You can choose how much principal you want to pay anytime. You can also pay off the entire balance anytime without paying a prepayment penalty. What are the factors that you need to consider while applying for a HELOC loan? The first thing is the credit score. Your credit score needs to be good. The debt to income ratio. This is what the bank or the financial institution would look at to ensure that you are able to afford paying the interest. And third and most important is the value of your home. You need to have a significant amount of equity in your home. When you are applying for home equity line of credit, you will need to prove that you own your home. You will also need to supply the mortgage details, such as the current mortgage balance, the term, and the amortization period. And you also need to have an appraisal of your home. The lender may need to know how much is the value of your home. The other thing that you need to remember is that you must pass the stress test. You will need to prove that you can afford the payment, and that's at the qualifying interest rate that is typically higher than the actual rate in your contract. You need to pass the stress test even if you do not need mortgage loan insurance. Credit unions and other lenders that are not federally regulated may choose to use the stress test when you apply for a HELOC, or they may choose not to. The banks are required to use the stress test. There are several factors that you need to consider before applying for a HELOC. You need to determine whether you need extra credit to achieve your goals, or could you just build it up using your savings instead. The reason is because when you borrow, you need to pay. Somehow you need to make sure that you are able to pay down that interest. If you decide that you need to pursue the HELOC route, consider things like flexibility, the fees, the interest rates, and the terms and conditions. Always make a clear plan on how you plan to use the borrowed money. Make sure that you create a realistic budget for your project so that you don't run out of money. Determine the credit limit that you need. You don't want to use up all your credit. Shop around and negotiate with different lenders. If you work with me or my team, we are able to help you negotiate and get you the best rate. Always create a repayment schedule and stick to it. There are questions that you need to ask your lender if you are going directly to the lender. What do you need to qualify? So they will tell you exactly what they need. Maybe they will need notice of assessment, employment letters, etc. Also, what's the best rate that they can offer you? You need to know what are the terms, because the terms may also have a bigger effect. If you need HELOC or you need a mortgage, we are here to help you. We can help you get the best rate and the best value, guide you even through the process of utilizing your home equity line of credit if you want to use the funds to do an investment. So thank you very much. This is just a quick summary of HELOC. Hopefully you've learned something, and if you need more information, please contact me, and my team will be able to assist you in your quest to get a mortgage or home equity line of credit. Thank you, and God bless. Bye.